the dot plot, actually, the last one we got, didn't show us that interest rates would go much higher than now. Just it clearly showed that they're going to stay there longer at these levels. And that means they're going to affect much more market participants.
Welcome back to Soar Financially, everybody. Thank you so much for joining us for another exciting discussion. And I'm excited to welcome back a guest I haven't had on in 12 months, 18 months. It's been way too long. He's been a guest at our DEUTSCHE GOLDMESSE in the past, and we've got some tremendous feedback on his presentations. And I'm a subscriber to his weekly newsletter, a fantastic newsletter, because he does a lot of technical analysis, and it's all pure trend-based. There's no emotions in there. Of course, there's some analysis, but it's just fact-based. So I really like reading it because it keeps it clear. It keeps you clear-headed, right? Before I switch over to my guest, Christian Vartian, please make sure to subscribe to the channel, hit the like and subscribe button. If you have any comments about the discussion, put it down below as well. We do want to hear from you. Now, I've said my piece. Christian, it's great to see you. Welcome back on the channel. It's good to see you again, my friend.
Thank you very much. Thank you very much for having me. And very, very good day to all listeners and viewers.
Absolutely. Christian, you're joining us on vacation. Like, I tremendously appreciate that. Not everybody does it. So appreciate your time. And I'm not going to waste too much. So let's jump right into it, into the discussion here. Because I want to start off with asking you, like, how are we doing? How's the economy doing these days? How close are we to maybe a potential looming disaster here?
Look, I mean, that's a little bit a complicated question. If people want to look at charts, I didn't have a prepared chart for that question. But if you compare, let's say, the NASDAQ 100 compared to the Russell 2000, you will see that actually something like a recession is already arriving. Just it's arriving in the mid-cap economy, and it's not yet arriving in the big cap economy, so to speak. And the pure reason is that interest rate increases are important in a double phenomena. The first phenomena is how high does the interest rate go, but the second phenomena is how fast did it go up? Because if it went up very, very fast, that means many companies which are able to issue their own bonds are not affected yet a lot. Why? Because the low interest older bonds are still running, so they're still alive, and no refinancing at these dramatically higher interest rate levels that we see today has been necessary for those companies, while other companies, smaller companies, which are not able to issue bonds, might already have had to refinance at those new rates, okay? So it's very important to understand that these interest rates do not affect everybody yet. This is also why the market reaction as to the Fed dot plot was dramatically more important and more grave than the market reaction as to the Fed interest rate policy. Because many market participants and real economy participants actually thought that the interest rate level would go up sharply, further on decrease sharply, and maybe the time that was used for both of these movements would still be smaller than their refinancing schedule, okay? And the dot plot, actually, the last one we got, didn't show us that interest rates would go much higher than now. Just it clearly showed that they're going to stay there longer at these levels. And that means they're going to affect much more market participants. Sorry that I was complex, but it's very important.
No, it's a complex matter because I don't think it is a straightforward answer either. As you said, I think there's a bifurcation going on with a recession probably hitting one part of the economy while it's not hitting the other part of the economy. As you said, companies that were able to refinance, I just had to think, I think it was Kinross or so, or Equinox Gold, jumping to the miners, I think refinanced or issued a bond for 4.5%. Which I thought was quite impressive in this rate hike, in this current rate environment.
But those who are sitting on the old bonds, they still pay 1.2.
Yeah. It's a
That's the
massive
point.
difference
So the
still.
question is, how long does it last, right? Yeah.
Absolutely. So massive bifurcation going on. There's like, is this one of the indicators you're looking at? Like, do you see cracks in that system? Because if you look at the S&P, for example, the S&P 500, it's only seven, the magnificent seven, obviously carrying the index. And what kind of indicators are you looking at from the small caps to mid caps? Where, yeah.
If you ask me about real economy indicators, not too many, because what you can use is aggregated data about the length of refinancing strings, right? As I said before, the only thing which is important in the moment to identify subsectors is to have a database telling you what is the average length of a bond of that subsector, okay? And of course, tech, first of all, is pretty much filled with money. And on the other side, had no problem to get money for long term. Yeah. So if they issued, let's say in 2019, a 10-year bond, they're not affected yet at all. This may also explain, I'm talking not just from the cost side, right?
Yeah.
Why tech or why the Magnificent Seven, as you quote very correctly, are outperforming the rest. But it might also be true for some good performing, rather real economy companies like Dow Chemical. There is some of the Dow Jones companies which are pretty much also outperforming the market. Yet, of course, not like Nvidia. Okay, but it's clear because there's no new product in those older companies. But if you're talking from the financial side, there's pretty much some very big, very old, very long-term refinance companies which have the same advantage on the money cost side. Of course, on the product side, it's something else. Nvidia was, of course, the biggest boost in artificial intelligence, and I'm very happy I had plenty of them. I did double my pieces of stocks early enough because in that we're good to call the right thing at the right moment. But to give you an idea, there it's actually about your market power when refinancing, right? And so if interest rate levels stay even at the actual levels for another 3 years, there certainly is going to be a recession. No. There's no way out. But the question is, how long do they stay at that levels? And I think we already have a recession in some sectors. If you talk the US, in other parts of the world, there's certainly already recession.
It's interesting that you use the time frame 3 years, for example, higher for longer, right? Is one of the terms where everybody uses these days.
I said three more.
Yeah.
I said three more. So two we have. Okay, that's five. And the average maturity of the debt of let's say companies certainly under 5.
Yeah, it's like, but you think, like, since we're on the interest rate topic, like that the Fed is done raising rates, it's going to let it play out as it is right now? Because we're looking at inflation data, unemployment. It's not really suggesting a potential like drop in rates here.
No, not a drop. But as I mentioned, I don't think that we're going to go from the actual level to 7 or 8. I don't think that. And it's not necessary because the impact of the actual level of interest rates in the money market, which is actually what the Fed does, Fed cannot define the capital market interest rates, but only the money market interest rates. I think we're pretty much done. I mean, they might raise for another 50 basis points or some, or even lower for 25 basis. Doesn't matter. In the actual situation in which we are, it only matters how long they are so high, nothing else. Because they didn't arrive. They actually didn't arrive in the markets, okay? Only in parts of it, because of what I explained at the start of the interview.
Yeah, absolutely. Like, one thing I'm looking at on a daily basis here is the crude oil and the Brent prices as well, and that's something outside of the impact of the Fed.
Absolutely.
Like, right? So how does that play a role into potential rate hikes or higher for longer or just potential pause as well?
It actually shouldn't. Because if the Fed would actually act in a macroeconomic correct way, and if you talk about inflation, which implicates a monetary phenomena, not only price increases, but a monetary phenomena behind the price increases. And there's political setups with embargoes or decisions by OPEC Plus to lower the output of oil, this is not something that you can change by monetary policy. So actually the question is, will the Fed act accordingly, or will they continue to play that any scarcity is automatic and inflation? You know what I mean? So actually they should start to ignore it, because you can't fight scarcity by political decisions. You can't fight that with the tool of decreasing the money supply. It just doesn't work.
Like, one topic you've discussed in your recent letters the last couple of weeks is disinflation and dropping prices, or the matter of disinflation. And then, of course, probably misquoting you here right now. I'm thinking about it.
No, it's fine.
But it's
fine.
you have to import more, or you had to import more in the past. Sorry, that's the topic. I twisted it around. You had to import in the past, or we did import in the past from China, Bangladesh, Pakistan, India, from low-cost countries with lower wage costs and labor costs. But now the reshoring and bringing things home, producing at home, is driving prices, of course, as well. And that, again, something that's outside of the control of the Fed. How is that?
Absolutely, it's not monetary at all. This phenomena is not monetary at all. It is actually a reshift in macroeconomics, or would even call it maybe the end of monetarism. And what it's going to do, first of all, prices will increase and other prices will decrease. And whatever those prices are doing, if they readapt to a situation we didn't know 35 years ago, since 35 years ago. So if we will find ourselves somewhere in 1985 at the best, okay, as a result of this shift, and the best thing we can do is actually remember the cross pricing of 1985, in which a car which was much more expensive compared to a house than today. Because importantly, as we all know, we could have almost zero interest rates in the West, and we could have still no inflation or no significant inflation while having so low interest rates, because we could import deflation, as you mentioned correctly, by buying cheaper goods from abroad. But there's one thing you could never buy from abroad, and that's real estate.
I wrote that down.
Buy Chinese real estate and put it to Arizona. It doesn't work. So that's why real estate in Europe or in the US, doesn't matter, was through this phase getting artificially more expensive as compared to industrial goods. And that phenomena is going to reverse if the import of deflation ends. So real estate is going to be cheaper compared to industrial goods.
Do you have a forecast or an idea of what that would look like? I'm just curious, because real estate, and I'm looking, there's whole economies built on vacation rentals now, side hustles and side businesses, because I think it's going to affect a lot of people that started that as a second job as well. So I'm just curious, like, what the real impact on the economy might be here.
Look, I mean, I did actually mention it as good as I can if I'm serious. And what we know and what we can measure is the cross ratio, okay? Now, in absolute dollars, it's a question of how the amount of dollars will look like. I can't predict you in such a longer time frame, but I can absolutely assure you that real estate is gonna decrease in value compared to industrial products, even stocks, if it's industrial stocks, and also compared to gold or silver. This is clear, because this was the only thing which couldn't be imported cheaper. Okay, and now other things can also not be imported cheaper. As a consequence, the ratio is turning. And that's very important for investors in asset classes too. So if you have too much real estate, rather sell something and buy some mining companies or so. Not only, I mean, tech also. You know, I have mining companies. I have more tech than mining, but I do have mining companies. Even though I have less mining companies than physical metals, but doesn't matter. Important is to grasp that real estate couldn't be imported the last 35 years from China. So that means there was no imported deflation there. That means that, for example, if you look to Germany, a flat in Frankfurt compared to Mercedes did increase. The ratio did increase in the last 35 years, flat in Frankfurt compared to Mercedes. And now what's going to happen is the flat in Frankfurt is going to sink against the Mercedes. Now, in absolute euro or dollar terms, I can't tell you long-term what this means, because that's another question. It's the question how much of this monetary fiat is there, right?
Yeah.
This ratio, I would actually sign that this ratio is gonna shift if it's not shifted already.
Okay. One follow-up on the real estate market. Supply seems to be an issue in real estate as well. North America, Europe as well, to a degree, depends on the certain regions here. Within Europe, do you factor that in as well, a supply deficit in terms of housing?
Oh, yes, there is a supply deficit. Still, there is a supply deficit in the moment. But it's not going to last very long, because, you know, a supply deficit is based on an actual level of demand. And the level of demand is not adapted yet to the changed international situation. And if people are still looking for a cheap 300 square meter house, I mean, maybe they have to understand that they can only afford 60 square meters, you know what I mean? And as long as this didn't happen yet, you can call that phenomena a supply deficit. But anyway, with the interest rates that are necessary to be paid on a new loan, new as of now, they anyway can't afford it. Okay. So it's not a supply, it's a wish of a child. You understand what I mean?
Yeah.
So this demand is not a demand anymore, because, okay, they would like to have it. Yes, would like to have, but neither is there the offer cheap enough, nor is there the money cheap enough to achieve this. So in my opinion, the term you use as a supply deficit is valid as of now, as of the latest, but it starts to be more and more an irreal dream. People have to adapt that they have to live in smaller entities.
You brought up the topic of that you can't control the supply and the amount of money in circulation, which brings me to the question: do you think there will be QE again, meaning quantitative easing, and a flood of new capital or flood of new money in the markets?
Look, if you ask me, I'm almost sure it will. The question is, how long does central banks stick to a definition that at least now they already know that it's wrong. In all articles and for my clients and portfolios, I did since long say it's wrong, because price increase is not inflation. We don't have inflation since at least 3 years. So it's bullshit. There's no inflation. Yes, there's price increases, but not inflation. Inflation is something else, but doesn't matter. Okay. The point is, again, if you took for the oil, for example, so there's an embargo on Russian oil. This is a reduction of the available quantity. Fighting that with monetary supply is complete bullshit. You can't do it. It doesn't work. It doesn't go there. So the question is, when do the central banks officially recognize that there's price drivers like fossil fuel prices, which do indeed drive prices, but which are not technically inflation. Inflation is a price increase because of an increase of money supply, not a price increase because of scarcity of supply of the good. Okay. So if there's a scarcity of supply of the good, you can't almost do anything with monetary policy to stop that. You know what I mean? You can crush the demand if you do it extremely. So, and that's the way on which we are. So either they continue to pretend that scarcity is the same thing like inflation, or they print. But if they continue to fight it as an inflation, that's gonna be a pretty crash.
Because they're fighting fire with fire, right? Like they're adding just fuel to the. They're just adding fuel to the fire that they have created, just pouring more fuel on it.
Yes, absolutely. Plus the factor of the time, as I mentioned, because the interest rate level doesn't affect everybody yet. But every month the level is in a range that we have today, it's going to affect more and more and more people and companies. And I doubt that the Fed or other central banks have a good statistic how this is going to work out. As to my analysis, it should rather work out hyperbolically, because you get then, you know what I mean? It's not linear. You cannot say, let's say an interest rate level around 5%. If it's lasting a month longer, it's going to do 5% more inflation fighting. Maybe you reach a point where a month longer is 30% deflationary. You know what I mean? Because thereof, others have to refinance, more people have to refinance, and suddenly it's working. And in that moment, you would go to a deflationary spiral. And I think that they would have to do QA again, if not already for the bond prices themselves. Because bond prices, the development of bond prices was a pure catastrophe since 2020. And they might actually have to save the prices of the treasuries by buying them because of the price of the treasuries. And if not because of the price of the treasuries, it might well happen because the inflation fighting tools will actually have a hyperbolic impact. That means at a certain moment, it's going to be a full break. Even without changing the rate anymore, like 5, it's 5, okay. And then 60, 70% or 80% of market participants will have to really pay that, plus a margin, yeah? So they will switch from an interest rate cost of 2% to an interest rate cost of 7.5%. This is actually going to crash, yes.
It's interesting, like maybe to sort of wrap up the recession discussion here and market crash discussion. One thing I've noticed is a lot of it, like even in my friend circle or so, the recession as we were in Germany is like it's not really a topic, right? Theoretically, Germany's already in a recession, but as per textbook definition, negative GDP growth, it's not looking good. We're in a recession, but it's not being discussed. I don't think anybody's feeling it yet on a broad basis. All right. So is that
Again,
how does that fit in? It's like I'm just trying to make sense of it, because on this channel we discuss it a lot. But
the interest rate level is not valid for long enough yet. Once they have to pay it. I mean, increased interest rates are funny if you don't pay them, right?
Good point.
As the majority has to pay it because they're lasting long enough so that the maturity is actually running out of your cheap old loans, they're going to feel it abruptly. I'm saying abruptly. This is not linear. It's not progressive. It's going to be abruptly. And everybody who understands mathematics knows that.
No, interesting. Like the only comment I've had from a friend is he's holding off buying a house right now because mortgage rates are too high. He's not interested in paying 6% or whatever it is in Germany, 4.5%, 5% for mortgage rates, right? So he's like, nope, holding off. So that's the only thing. But let's put a bow around the recession discussion. Let's talk about how it affects the commodities. That's a big part of our channel here, obviously, as well. Maybe we start with copper, Dr. Copper. I just today, copper marked a new one-year low, $3.55 a pound. Not crazy cheap, but it's been at a much higher level. So what is the price forecasting for you? Like, what's Dr. Copper telling us?
I wouldn't see big jumps in copper for the next years. The question is for copper is actually what is the broadband industry doing, and we might have the low in because, as we both know, is that the People's Bank of China is already starting stimulus measures for the Chinese economy, and the relevant economy for the copper price is the Chinese economy. And I would say in China, the deflationary policies are over. Okay, so concerning broadband commodities, electrical use like copper, we could be somewhere in a bottom range because it's really depending only on China. if you look the copper demand of so-called Western industrial nations is not able to really seriously influence the copper price anymore. And China has now switched to an expansive monetary policy. So, okay, that's also why I'm pretty bullish for metal commodities, even though China doesn't play the same amount of role in the gold market like in the copper market, right? So the copper market is more important because it's not a very expensive metal, and it's depending on broadband industry. But I think the switch in the Chinese policy towards a more accommodative, even expansionist policy is the main driver for metal commodities. Now, in general, right? Not for everyone the same, but the main driver for metal commodities. So there is not so important what the Fed is doing.
As you said, like the Western markets are too small to factor in there.
As a demand factor, yes.
Yeah,
yes.
okay. Interesting. Okay, base metals, copper sort of ticked off. Now we have to talk precious metals. One thing I've noticed in your letter, you've increased your gold exposure in your portfolio. So you care to explain?
Oh yeah, I can explain it. I mean, part of it was passively, because if you have a portfolio and actually there's a piece of the portfolio which is rising, it does the job itself, right? In value, on value based, it's increasing its share, right, by itself. Plus, I did sell a little bit of palladium, but not at these prices now. This was a little bit much more expensive than now, and bought gold instead. So there was a passive factor, which was just that gold did rise. I'm now talking relative to other parts of the portfolio. Okay. Gold did rise and other commodities didn't. And also I did switch some palladium to gold as palladium was still more expensive than gold. It was sharply more expensive than gold, and I did actually sell some palladium and buy some additional gold. That was the active part of it.
Gotcha. In your letter, you mentioned that gold is a benefactor of the current crises. The question is now we're trading about 1970 gold. How long will that last, and is it sustainable?
Look, everybody who understands the world, the physics and mathematics knows that the word sustainable means nothing.
I didn't even mean it in an environmentally sense.
There's no sustainability in that. Okay, what we see on charts is marginal prices. As you know, it's the price of the last entity traded. So the prices have nothing to do with sustainability and cannot be sustainable. This is why I also don't think that gold will continue to trade at those levels. And my algorithms tell me that it's rather to the upside that we're going to leave those levels that we actually have.
Interesting. Okay, so you're predicting a much higher gold price from this point on. Just trying to nail you down a little bit.
I think that the situation that is cooking now is able, together with some switch in the Western national banks, which understand that it's just about to crash the market and switch their policy a little bit. I think we could go out of this boring range of being under 2100, yes. Because we have a double top, as you know, it depends on the chart, however you want to read it, to 2070 or 2075 or whatever. And I think that the soup is cooked, that we can leave that zone finally.
Interesting. Okay, yeah, fantastic. I personally,
and by the way, if we want, we're gonna leave it downwards. Okay, so I don't think that we're gonna, we're not gonna all the time have the head on the ceiling. It doesn't work. No. Okay, so we didn't last week. We didn't break the 2000. We actually touched it. We didn't break the 2000. But on the other side, I rather think it's the upside. And if I say upside, it's upside. That means real new all-time highs are somewhere in the cards. Okay. But real, that means 2-1, 2-2, something like that.
Fantastic. And silver will tag along? Will they?
Silver is another story, because we don't have. First of all, we have to remember that silver didn't make any all-time highs in the years 2019 to 2023, zero. Right. So we are we are at the price level which is dramatically under the silver all-time highs or the silver levels of 2011, 2010. In gold, we are much higher than that. So gold has actually performed alone, right, the last years. Silver didn't perform at all. At all. I mean, okay, yes, increase a little bit, but we are totally other ranges. Why? It's very simple. It's always the same story. People tend to say that silver is an industrial metal. I always said yes, okay, but be a little bit more precise, because it's you can't say silver is an industrial metal like that. It is an electrical industrial metal today because we don't use photofilms anymore. So the main use is electric, and it's electric in bigger engines. So it's not in a smartphone. Okay. So, but now that we go seriously to this, let's call it sustainability and energy stuff, you're gonna finally have to build new power plants, and those are gonna eat a lot of silver, because a power plant is big enough. Silver is enough heat resistance in a power plant. Might not be in an iPhone 14, but power plant is big. There's enough air, you can cool. Okay, so that one plus the photovoltaic explosion, which certainly will continue, should give the hand under the price. Yeah. This is the point when we saw it already since several months. This is a difference to gold, by the way, because you see commodity strengths you won't see in a chart while the chart goes up. Commodity strengths you see in a chart when the chart has reached a resistance and goes down, and then it doesn't really go down, right? Because it's logical. Most of investors or traders, they buy something because it goes up. Okay, but a commodity person who needs them, he's gonna try to get the cheapest price within the time frame when he needs it. So he's gonna buy when prices are going down. And you see, sociologically, we have algorithm to detect that since minimum of half year, silver is being bought when it's getting cheaper. And this shows you that there is a strong other kind of player in the market. And that's just people who need silver as an industrial commodity, because they want to buy cheap, right? They don't want to buy because it's rising. Well, it's logical. You don't want to buy something because it's rising. An investor might want to buy it when it's rising. And if that combination occurs, that we get the hand under the price, as I call it, strong commodity demand, right? Together with some trading and chart factors, which are not much different than the ones for gold, we could finally see a breakout over the downtrend line, which we have now since more than 13 years, more or less. No, sorry, 12 years. And actually reach or approach even new time highs in silver. But in silver, the key issue is to finally break the downtrend line to the upside. And yeah. I put some two charts. Is a pretty, you don't see it here. It's a pretty simple downtrend line, and we touched it several times. We actually at the upper part of the silver price today is all the time touches of the downtrend line. It doesn't go through it. But one of my indicators already says that the next target is over the line. Okay, so even the mathematics already say that it should be over the line. If you combine now the industrial factors I mentioned with green revolution, which need other power plants, we can say it needs power plants. Every power plant will need silver. Plus photovoltaic needs less and less silver per collector. But if you increase the amounts of collectors so multifold, there should also be a higher demand for silver physically, just for electronic purpose. And I think, or at least my algorithms think, that we saw it already the last 6 months, because there is some ghost under the price, which buys when the price goes down. The combination of it should actually allow here that we break the downtrend to the upward, and Thereafter, I see a pretty lot of way to go upwards.
Fantastic.
But we have to break it. You see it.
Yeah.
I mean, we did actually, it's a resistance and a brutal one. But it's not at a constant price, because a downtrend line actually is not a horizontal line. So, yeah.
There's some
I think
variability
we're going to make
there.
it. I think
Yeah.
we're going to make it.
Fantastic. Christian, earlier you brought up mining stocks, that they're a good buy. Let's sum up the conversation here, or maybe use mining stocks as the last topic of conversation here. How do you think the mining stocks will perform in the coming months? Because you know it, I know it, it has been absolutely abysmal out there. Performance has been horrible due to a lack of liquidity, a lack of inflow of capital as well. Is the tide finally turning here?
Yeah, certainly not for all companies, but
I sure hope it's not for everybody.
yes. But we certainly think that some of the elite companies could actually triple their value. Because if we break, especially silver companies, because if we really break that downtrend line, I mean, it doesn't look like we're going to stop at $30, $32, right, per ounce. We're going to certainly test the $40 or something like that. And combined with other factors like the scarcity of silver needed for electric purposes, sorry, not electronic. I could pretty much imagine that the silver price makes from here like 35% plus. And so a good mining company should make from here, I don't know, 200% or something, right? Because in a mining company, the costs are there, right? And if they're just the earnings are much higher because of the higher prices, with costs which are not affected by the higher prices, you know, in the first phase at least, profitability should triple.
Margin compression was a big topic amongst the majors in recent quarters as well. Barrick just announced that there might actually be dropping or lowering costs 6 to 8%. I think we'll get final numbers any day now here. I don't have the exact date in front of me, but that's interesting. Christian.
I didn't say buy them now immediately. I said wait until the price does it. Because for the price, as we all know, if they cut cost, it's good for the price because it's going to little bit limit the output. And less output is better for the price, right? You see it in Bitcoin. It's not the time for Bitcoin, but it's so scarce. Nobody produces Bitcoin anymore, almost, right? Halvings are seldom. The top level is already near top quantity. So having less of a merchandise is normally good for the price, right? Okay, now if we're talking about the companies who produce it, there it's double shifted, right? Okay, double-edged, it's clear. But I think that the negative factors like the very high energy cost and the very high interest cost are in already, while a price upward explosion is not in already. So the question is now, do you have enough mining stocks in your portfolio or not? Okay, every portfolio is different. I could imagine doubling my mining exposure because I'm not filled with mining very much at the moment, right? I have some, but I'm not really full. And I'm going to wait until we really make that line, and then I'm going to load the boat.
Fantastic.
And I mean,
yeah. Awesome. Because I think that you're describing what a lot of people are waiting for. They're waiting for some term of price move, and it's almost a bit annoying because the companies say, well, at $2,200 gold, everything will be different. They've been saying that when we were 18, they said, well, $2,000 gold will be different. So I'm always curious what the trigger is, but obviously breaking through certain trend lines should at least trigger some algorithm trading
valid
and
for
exposure.
Silver, right? Gold is not cheap in the moment. Nobody can argue that gold is cheap. Okay. As a gold investor, I would be happy that some of my mining stock in gold, but especially my quantity of physical gold, is going to increase. But there's not a big story on the upside.
Interesting.
The big story is with the metal who didn't join the performance of gold in the last 5 years, and that's silver.
That's silver.
There is the big story. For the first time since more than 10 years, I see a hand under the price, which is the basic for creating a story. Also, downtrend line has the sympathetic characteristic that it goes down, so it's easier and easier to break it, right?
Well, the hurdles are getting lower and lower, absolutely.
The hurdle is getting lower, plus the photovoltaic. So that situation is for a breakout. And yes, I have physical silver. I'm sure you have also, Kai. Physical silver will certainly then have a very nice boom, but the key factor is for the miners. And I'm gonna load the boat with additional mining exposure. I say again, I have some mining exposure, but I'm gonna double it once I'm sure we cross the trend line in the output product, which is the silver ounce, okay?
Gotcha.
But then I'm not gonna think twice, I'm gonna do it immediately.
Mm-hmm. Fantastic, because that's exactly what you're looking for, the catalyst. Great. Fantastic. Yes. Christian, I think we can put a bow around. Thank you so much for your time. I think it was very comprehensive. We ran through the macro, we ran down to the micro, meaning the commodities and some of the mining stocks here as well, and sentiment. Really appreciate your time, that you're taking 40 minutes out of your day while you're on vacation here to chat with us. I tremendously appreciate it. Where can we find more of you? How can people reach out to you?
Look, I mean, a portfolio policy and a portfolio in which in the moment we have 18% gold in the total portfolio of what we have. We are full of tech stocks. Who has 18% gold? Nobody. There's people who have 5% gold because they say it's an addition, and others are gold bugs, they have 40. Okay, so that means if my clients have my portfolio, and the normal way of implementing that is family offices, okay? Not so much funds, rather family offices. And otherwise, if somebody has questions, welcome to answer those questions. But we're doing portfolios as a primary thing, and people want to have their metal at home or in their old wall. So you understand that we are small in delivering to funds, because a fund is killing you the precious metal advantage, because you don't hold it yourself. It's also killing you the crypto advantage. We have 10% cryptos in the moment because you don't have your private key, right? And you can't go to Tim Cook on an Apple General Assembly if you have Apple through a fund and tell him, look, Tim, finally you made notebooks thick enough that they are able to use their processor power, because before the design was nice, but bullshit. It was just too slim, always went hot, and the Core i7 just performed like a Celeron, right? Because it was getting hot. And these things, if you want to do those things, okay, touch your own gold, have your own key in a Bitcoin key, then you're gonna be my client in a kind of family office style. That's why you won't find me in a big fund management, not because I wouldn't be able, or my clients are too small. We have a lot of things which follow our work, right? A lot of capital. But by definition, it's not fund type, because the fund type is actually jeopardizing the content, right? In the view of the customers, not mine. So the best way, if somebody really wants to have added value from me, is to contact me directly, I think.
What's the best way to do that? Where do we find you, Christian? What's the best website or LinkedIn?
It's not what I know. Look, what I prefer is to send me an email.
Yeah.
I actually closed down most of my websites because many people did create a misunderstanding by thinking that you can pick a call in the framework of our portfolio and take it out of the portfolio. You know what I want to say?
Yeah.
So in order to avoid misunderstandings, and we are full of clients, really, we have no problem with profitability. Myself, zero. Okay.
Okay.
So my point is now, best contact me. Okay. Yeah. You heard my silver call now. I gave you a real estate call in that interview. It is a relative call. It's about a cross rate. Now, if somebody says, look, guys, I don't want your portfolio, make me the cross rate. I can do him a cross rate. But please, Kai, understand me. I cannot have a ready-made web page which explains you a cross rate trade, which can be done, as you know. You can
too static. It's not dynamic enough.
Exactly. Yes.
Yeah. Fantastic.
So
Fantastic.
just
No.
best is contact me.
Yeah, no, fantastic, Christian. Really appreciate your time. Thank you so much for joining us here while you're on vacation. Truly appreciate it. Stay on for a second because I got to do the outro real quick because I really appreciate everybody tuning in. Thank you so much for watching Soar Financially here, where we discuss the macro to understand the micro. If you want to hear more from Christian, make sure to subscribe to this channel because the more you subscribe, or the more of you subscribe, the more I'll be able to bring him back, hopefully, and to make it worth his time, obviously, to share his insights. Because they're, as you've noticed, they're without emotion. He looks at charts, he looks at trend lines, and he bases his decisions on that and jumps in quickly without overthinking it. He puts out a weekly newsletter as well, so reach out to him. Maybe you'll get some access. You become a client of his. I read it weekly. Really insightful, as I said, without emotions, without a lot of filler words. It's straight to the point. And, of course, let us know what you think as well. Is he right with his calls? What do you think is going to happen? Are we in a recession? Are we heading to a recession? Or is everything going to be absolutely rosy out there? You're watching this video, so I'm sure to know what kind of impressions you have of the market out there. So share your thoughts anyway. And if you haven't done so, hit that like button as well. Thanks so much for tuning in. Thanks to our sponsor, Money Metals, for sponsoring this video. It's much appreciated. And stay tuned for more. We'll be back with lots more content.